Hi guys! Welcome to another episode of Financial Tidbits here with me, Royston at NOF. Today's topic is on Growth ETF. When we talk about Growth ETFs, there are a few popular ones which always comes to our mind. First, we have the QQQ ETF, which tracks the 100th largest tech counter in the US as represented by the Nasdaq index. This is the largest pure-play growth ETF out there, but not necessarily the best, as I will explain later. Next, in the past year, everyone has been talking about the ARK family of growth funds, headed by now renowned growth investor Catherine Woods. Her track record over the past 1 to 2 years have been phenomenal, but those funds have lagged the market big time in 2021. Is that an opportunity to buy on the cheap, or has her growth era ended? Well, you decide. Instead of rehashing what everyone has already mentioned with regards to these growth ETFs, today I'm here to introduce to my viewers 5 growth ETFs that have been flying under the radar and not commonly spoken about. More importantly, these growth ETFs have consistently outperformed the S&P 500 over the past decade, as well as more recently on a year-to-date basis where growth has become a laggard. Note that none of these ETFs are your leveraged ETFs. Let's start with the first one, which is also the largest in this list and a better alternative compared to the QQQ ETF in my view. This is the Vanguard Information Technology Index Fund ETF, or VGT for short. This is a pretty big ETF which boasts a market cap of close to 50 billion and focuses on buying into both large cap and small cap tech stocks. This is a fund that is quite exposed to the performances of both Apple and Microsoft, both stocks having a combined exposure of 35% in this ETF. Compared to the QQQ ETF, this ETF has been a much better performer over the past decade. Another thing to note is the ETF low expense ratio of just 0.1%, not as cheap as the Vanguard Growth Index Fund ETF, or VUG for short, at 0.04%, but VGT has a much stronger historical price performance. So this is our first ETF which I believe is a better alternative for investors to invest into the broad-based basket of tech counters versus the QQQ ETF. Next up is the Van Eck Vector Semiconductor ETF, or SMH for short, which invests into a basket of semiconductor stocks such as TSMC, being the largest stock in the portfolio, followed by Nvidia, ASML, Intel, and Micron rounding up the top 5. I've recently done up a semiconductor video which focuses on finding under the radar semiconductor stock gems that are not your typical Nvidia or TSMC, for example. One of the mentioned stock in that video has skyrocketed by 30% over the past 2 weeks. For those who don't wish to invest into individual semiconductor stocks in lieu of their volatility, but yet still wish to partake in the tailwind associated with the semiconductor chip shortages, then buying into the SMH ETF is one good way to clear it. This ETF has also consistently outperformed both the S&P 500 and the Nasdaq index over the past 10 years, and I believe that outperformance will likely continue with the advent of 5G boosting chip demands in the coming decade. The third growth ETF on our list today is your iShares US Home Construction ETF, or ITB for short. This fund buys into US companies associated with the home construction sector. The top 3 holdings are D.R. Horton, Lennar, and MVR, all solid and reputable home builders, but the fund also invests substantially into companies such as Home Depot and Lowe's, which are more of your typical home improvement retailer. With lumber prices correcting substantially and US home prices rising at the fastest pace in more than 30 years, this will likely flow through to construction companies. As can be seen from this chart, home builders' stocks have been lagging that of the house prices since 2013, and there's a pretty good chance that the gap will narrow soon. Buying into an outperforming growth ETF such as ITB, which has been consistently outperformed the S&P 500 with year-to-date returns of almost 20% is a good way to play the US housing boom. The fourth growth ETF in this list focuses on retail. This is the SPDR S&P Retail ETF, or XRT for short. This ETF invests into smaller cap retail names, with its top holding being GameStop. Now, I know that some investors would not be comfortable taking a position directly or indirectly into GameStop, which definitely is a high-risk stock. However, there's no denying that this growth ETF performance has nothing short of outstanding in 2021 so far and would be the ideal reopening ETF to partake in. While its longer-term outperformance versus the S&P 500 has not been as impressive as some of the earlier names mentioned in this list, it is still no doubt a good growth candidate for consideration, albeit a riskier one. For those who prefer the safer route, then the larger cap Vanguard Consumer Discretionary Index Fund, or VCR, could be an alternative. The VCR ETF buys into your more standard names such as Amazon, Tesla, Home Depot, McDonald's, Nike, Starbucks, all blue chip names with good growth potential in the coming years. The final ETF in this list is the Invesco S&P 500 GARP ETF that seeks to track the performance of approximately 75 growth stocks in the S&P 500 that exhibits quality characteristics and have attractive valuation. Its acronym GARP, or Growth at a Reasonable Price, was popularized by Hall of Fame investor Peter Lynch, who seeks to buy growth companies at a decent valuation. You have blue chip names such as Netflix and Salesforce as its top two holdings. Companies which the fund believes have good growth potential, while yet their valuation ain't stretched. There are also quite a handful of financial names in this list, such as SVB Financial, E-Trade Financial, and the financial services sector actually accounts for the largest weighting of 30% in this fund. This ETF's outperformance over a 10 years horizon might not be as outstanding as our other candidates in this list, but this is one ETF that generated 7% excess returns over the S&P 500 in 2021 so far, a rather credible performance considering the rather diversified nature of the stocks in its fund and the fact that most growth ETFs have underperformed the market. Are we seeing a resurgence in the magic of Peter Lynch GARP investing methodology? These are the 5 growth ETFs which I believe is less well known to most investors, and I believe they are credible candidates for consideration in one's portfolio. Note that all of these ETFs have substantially outperformed the S&P 500 over the past decade, and I would not be too surprised that their outperformances continue in the next decade as well. With that, we have come to the end of today's financial tidbits, and I hope that viewers have enjoyed this short sharing session. If so, please hit the like button and subscribe to the NUF YouTube channel. I will see you guys again soon. With that, this is Royston signing out.